Jeffrey Bierman. I'm broadcasting you live from Chicago, Illinois. Today is Tuesday. Yes, it's Tuesday, only Tuesday, November 4th, 2025. Good morning, TheoTrade members. I'm not going all bearish on you. Sorry, Don. It's a little early to get bearish, but I'm going to tell you right now, once we start the corrective move, none of you perma bulls are ever getting out of this. So it'll take you 5 to 6 months as my guess to get you out fully and wash you out. You have a chance to get out now, and you might bounce a little here, but I look at this not as a gap and go. It's going to be a death by 1,000 cuts. I think they're going to lull in the bulls today, buy the dip, and then they're going to really whack them. But in between that, we've got a program today which is trend driven. It's a surprise. I'm not going to go there. It's a 3 to 4 day program. I'm not in a hurry. Got to wait till 10 o'clock, but it's to help you understand how to navigate the market from one of the world's time-tested trend trading systems. It's a trend trading system that was conceived of by Alexander Elder. I'm going to expose it to you. I did it about 3 years ago. I did it prior to that 3 years. So every 3 years I come on, I talk about Alexander Elder because he's one of the 5 greatest technicians of all time. And I'm going to expose you to one of his trading systems. Even if you have no experience in the business, you could learn it in 1 day. You could learn it in 1 hour. Give it time, I'll get you there. All right, let's talk about the market today. And let me show you about, let me say hello to the usual suspects. Kevin Press, I see you. Buzz, good morning. Peter Schrader, how are you? Guatemala, gotta see Guatemala. Bart F, good morning. Who's else out there? Ship, Ronnie G, Eugene, Tim, Trains, I'm sorry. Trains, I respect. You come here every day, you get my respect. All right, let me roll forward and let's talk about today's theme. Hello, Jen. Rosario, good morning. Smalls, Judge Smalls. Got Florida Woody, he's one of my favorites, and John O'Donnell. Florida Woody's a Genesis Cog member. Respect, Florida Woody. All right, so much to say, so little time. Everybody, you know the theme, but give me 3 to 5 minutes to unpack it, please. So today's theme is death and taxes. Now, again, there's like a double entendre. There's some real deep undercurrents of satire, sarcasm, wit, but realism, okay? I know the market's down because whatever. I don't even care. The news media says, well, the Supreme Court is going to nix Trump's tariffs. Whatever. I don't even care what the reason is. I'm not interested. We're going down. That's it, okay? But here's the thing. Death and taxes is an idiom. Every single one of you have heard the expression in your lifetime, raised by your parents, raised by your grandmother, whether you're working in a business environment. You've heard this your whole life. You probably got indoctrinated in college, for God's sake, in a course that's economics driven. Death and taxes. Where does it come from? It's a phrase commonly referencing a famous quotation by the great American statesman on your screen, Benjamin Franklin. Our new Constitution is now established and has an appearance that promises permanency. But in this world, says Benjamin Franklin in a letter to Jean-Baptiste Leroy, Jean-Baptiste Leroy in 1789, Benjamin Franklin wrote, our new Constitution is now established and has an appearance that promises permanency, but in this world, nothing can be certain except death and taxes, okay? Although Franklin is not the progenitor of the phrase, his usage is the most famous, especially in the United States. So earlier versions actually emerged from the 18th century, include a line in Daniel Defoe. Remember Daniel Defoe, Robinson Crusoe? Daniel Defoe's The Political History of the Devil in 1726, and a quotation from The Cobbler of Preston by Christopher Bullock in 1716, which is the earliest known iteration of death and taxes. So if somebody says to you in a cocktail party and you want to harangue them out of a drink or try to get laid, here it is. Christopher Bullock from The Cobbler of Preston, 1716. He said, quote, you lie, L-Y-E, you lie, you are not sure, for I say, 'tis impossible to be sure of anything but death and taxes. That's Christopher Bullock, okay, from The Cobbler of Preston. Where am I going with this? Guatemala, Rosario, Tom, Peter Schrader. Where am I going with this quote? Why am I bringing this up today of all days in the world? And I love this one. This is one of my favorite ones. Rest in poverty. There's nothing as certain as death or taxes because it makes us all feel poor. Here's where I'm going with this. Listen to me carefully. Permabulls and permabears. I don't care what you're thinking, what your agenda is. You know one thing. There are certain things in life that are inevitable. You're going to pay tax at some point and you're going to die. It's a given. You know what else is inevitable? The market's going to go down. I promise you, the market's going to correct. And here's the thing. I promise you, it's going to go down at least 10% at some point. When? Don't know. Don't care. I'm positioned to get rich. How are you? How are you? Are you making money like I am on the short side? Or are you perma long? Always? People, the only certain thing I know about this market is I don't know what's going to happen every day. I don't. I don't know what the causes and the catalysts are. I know nothing. Nothing could come good coming. I know one thing I can guarantee. This market's going down. Garrett, it's going to go down sometime. And when the technicals turn and the algos attack, you're all screwed. It's going down. I'll guarantee that. When's it going to happen? Don't know. Don't care. For me, it's all about risk reward. If I position myself accordingly, I become a millionaire. And if I ride with the algos, I make it up even faster and defend my risk management profile. So I'm just telling you, the market's going to correct at some point. Oh, look, I got to short what I wanted to short. I covered this morning and reshorted on Unilever. It's great. I covered in pre-market at 60. I actually got it below 60. Hard to believe. So death and taxes means that inevitably we're going to correct. Now, where am I going with this with the catalyst? Okay, first off, weight of the world. You've heard this expression like Atlas holds the weight of the world. I know every one of you's heard that. Atlas holds the weight of the world. Where am I going with this? Okay. If a lot of you don't know this, and I'm surprised Garrett didn't bring this up. I'm shocked Garrett Baldwin didn't hit on this. Okay. Put aside all your biases. Put aside all your confirmation, all of it. The S&P 500, 44% of the S&P 500, 44% is made up of 10 tech stocks. Like, sit down there, let that kind of roll around in your head for a second. Nearly 50% of the market is accounted for by 10 stocks. Amazon, Apple, Nvidia. Okay, you know the usual suspects. You know who they are. Google. Okay, we know who they are. This is what I'm telling you. An analyst came out from Bank America that said the last time 40 plus percent of the S&P 500 was above a weighting of 40% is only two times in history. Two times. 1990 and 1996. Those are the only two times in history that has ever happened. Did the market implode after that? It didn't. But what happens at that point is when the market is that risk concentration, the data has shown not that the market's going to implode. So you perma bears, back it up and be quiet. Stop. It's just saying when the market is concentrated in 10 stocks of the major index, the upside of the market is virtually zero. That's the only thing I'm telling you. It's not that the market's going to 4,000. Stop. It's just that when the market's concentrated in 10 stocks, 45%, as it is now, 44%, the upside from there in every instance is zero. You have no upside, zero. So if you don't want to get out now, then don't. See if you're going to try to make it from this point on. But every time the market's hit there, it's marked a market top. It's a market top. It doesn't mean the market's going to drop 30, 40, 50%. That's bunk. It just means the market has so concentrated that it only takes one or two stocks of the 10 to drop the market and restrain it from going higher. This is the most unhealthy market of all time because value, nobody wants a value stock. Everybody wants to own tech and financials. And when that unwinds, who knows where we're going to end up. But I found that was, I call it the waiting game. I love it. Weight of the world. There, okay. And so I'm just like making you aware of that. This person who came up with this at Bank of America is a staunch bull. She's a stalwart bull. But she's saying that the risk of the AI bubble is causing this quote unquote over leverage into tech, which puts a top on the market. That's her argument. I'm just the messenger. So be aware of that. She's telling you the AI bubble, the $5 trillion NVIDIA, the $4 trillion Apple is making the market extremely top heavy, and it's stealing from the future for the present. So the present can't get any better because the future's already been materialized. That's what you need to be aware of. Next on here, a house divided. So one of the Fed governors is Austin Goolsbee. There's 12 Fed governors and one Fed chairman. Fed chairman, dunderhead moron Powell. We all go with that? Good. So Goolsbee and one other official were divisive at the meeting. Goolsbee's fretting over inflation, and more officials are now joining him. 2 weeks ago, there was only one person who was on the side of not cutting rates in November. One. Now there's three. A house divided. The House is the 13 governors who run the Federal Reserve System. You now have 3 of the 8 who don't want to cut in December because the inflation's out of control. You can tell me all you want, you perma bulls. You can piss on me and tell me it's raining. Inflation is totally, utterly out of control. It's going to get worse and worse and worse going forward, okay? And Goolsbee's worried that cutting the rates is only going to accelerate inflation. He's not interested in the stock market. Jerome Powell is because he's in bed with Wall Street. Goolsbee's not. He's just like an academician. He's a professor at University of Chicago. He's basically the Nobel Prize. He's a genius. The guy's the best of all the Fed governors when it comes to academia. He's telling you that more and more Fed officials are house divided. They're balking at the December rate cut. Here is my point. If we don't get a December rate cut, good night, permables, you're dead. The only thing driving this market higher, it's not the AI argument. We're already in an AI bubble. It's the Fed liquidity. Like Garrett says, Garrett's on it. The more they pump money in the market, the higher it goes. If they don't cut in December, it's going to create a massive tantrum in the market, a disappointment that's going to be met with heavy selling. Be aware of that. No rate cut means a sell. A rate cut means we can walk it higher. Be aware. Third, but last but not least, I call it a split personality. There's a consumer report that came out from TransUnion. Okay, there's TransUnion, there's ADP, there's all kinds of reports for credit. A TransUnion report finds that more consumers are shifting into the riskiest credit segment. Now, what does that mean to you, and how do you position around this? It means this. Consumers who are 780 to 850, that be me, 780, 50, our credit rating is improving. But consumers who are in the 600 and underneath are getting worse. Translation, the top 5 percentile in America are spending more and getting better credit ratings. The other, and then there's the 15% in between who are from 600 to 750. Underneath there, which represents 80% of America, 80% of America is 600 or below in their credit rating. It's getting worse. The actual weighted average number has declined 17 points over the past month. Translation, the rich are getting richer and spending more, and the poor are getting poorer, spending more and not paying their credit cards because they have to. They got to put it on credit. Everything's on credit now because they don't have any disposable cash. The bifurcation in the economy between Wall Street and Main Street is getting wider and wider and wider. Now, this isn't a political diatribe about Mondani and about consumerism and about socialism. I'm not interested in politics. That's not what I do. That's not what we do here. I'm just making a point that the sledding is going to get tougher and tougher and tougher until eventually you're going to see the high discretionary stocks blow. You're going to see the NVIDIAs, the Teslas, the GMs, the Fords, they're going to start to be pulled in because at some point, okay, the lower part of the consumer credit is going to drag the market down and jam it lower. At some point it will. You have a lot of time to get out of this. We're only down 40 points today. 40's bupkis. It's nothing. It's not even 1%. Lower your risk exposure. Follow me. Follow me. Every time we go higher, I lower my long exposure. I actually added a little bit long exposure today. A little bit. Not a lot, but a little bit. And I actually, I own Budweiser. I own Ball. They're up today. The stocks I'm long are up. But I'm also adding more to the short side. Be aware of that. Now, individual rotations. Rotations. Please bear with me and my bad puns today. My puns today are kind of weak. Taxidermy, like taxidermy. What do taxidermists do? Yeah, they do autopsies. Autopsies of dead animals. Yeah, guess what your dead animal is today? Yep, it's Uber. Uber's a taxidermy. Whee! There we go. Okay, what is my point about this? I like Uber for the long term. Johnny the Poacher, I like this in the long term. But if you own this, you got to get out now. You broke the algo channel. Bye, you're dead. Get out now. Get out now. It broke the algo channel on the daily. It's rolling over on the weekly. This is a good time. They made 311. Who cares? It's already priced in. The idea is as the economy gets worse, people will travel less and less in Ubers. They'll travel less and less in vacations. This thing to me is it's going to correct. And when it corrects, I'm going to start to look to buy it between 60 and 70. I like deep value. I like Uber for the long term. But right now, I think Uber is dead money. I call it taxidermy, which just means that it's just like a carcass just waiting to go lower. The stock is not expensive. It's not. At 15 multiple, that's not expensive. Not at all. It's cheap. The problem is, okay, the algorithms run the market, and once a level's been broken at this height, it's likely to go under. It'll probably retest 86. If it holds 86, I see it bouncing. If not, it's probably going to go all the way down underneath 80 at this point. Money's coming in, so the dippers are buying. But you never know how the algos react. If you don't get buyers to come in and bid this, could be trouble. I want to own this. Definitely want to buy this. I'm bullish on this, but not in this type of setup on that. Next on the list today. Under pressure. Doom, 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 doom. Doom, 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 doom. Under pressure. Everybody see this? Archer, Daniel, Midland. The Genesis COG has been short on this forever until yesterday. Why? Because we don't hold through earnings. I was short 2 call spreads. I cleaned up. I actually almost maxed out on them. I covered them, okay, between 58 and 59. Okay, check this out. It rolled all the way down and bounced all the way back. I want you to see this for what it is. The stock reports 92 cents. It rolls all the way down and then came all the way back. It went to 55 and fought its way back. Look at that. See that short covering? Why? The fact of the matter is they had a good earnings beat. They guided their numbers lower, but they didn't guide sales lower. They guided earnings lower. But you and I know this is the largest corn syrup manufacturer in the world. They're the largest soy producer in the world. The whole world can't live with Archer Daniel Midland. Everybody needs them in terms of manufacturing foods. So the stock has come back. Now, I didn't buy it. This is not the one I bought. But I can understand the stock coming back up because the fact of the matter is all they have to do is lift up prices and they make up the differential in their earnings. So the company warned, guided lower. But the fact of the matter is that a lift in prices will just make them make their money back because they were ahead on sales. That's the important thing. See that weekly right there? That's a bad short. Did you short today and you're dead? You're down $5? Shame on you for shorting. You don't need to short a stock where it's essential in a defensive play. This is a defensive play. This is the kind of stock I want to own. But the difference is I shorted up here to try to cover down at 56 just for that short distance. And I got my $5. but we closed out our trade yesterday when it was 59 and literally maxed out because the option was expiring on Friday. But this is a lesson. Don't hold through earnings. People like, you could have covered down here. True, but they could have opened it up $5 and ruined my call spread. So Archer Daniel Midland proves to me that sales matter more than earnings and that defensive stocks are going to make a massive comeback. I have no doubt in my mind that all these defensive stocks that have been crushed, including Kimberly-Clark, they're all going to come back because they're all just ridiculously cheap. It hasn't happened yet, but there's still plenty of time. Jumping ship. This is what I call the ultimate wealth effect stock. This moves in tandem with RCL. So RCL's down 13. I didn't get out. I'm a permable at 365. How is that looking for you now, genius? I keep telling you, to me, the market's easy. It is. You buy low and sell high. What Wall Street has conditioned you to do is to buy high and never sell. And then just keep buying every dip on the way down and it'll just go higher. This is proof positive that you can't buy forever. It won't work. Even NVIDIA is going to suffer this. Even Apple is going to suffer this at some point. They're going to correct them all, people. They're going to get them all. They're getting all these stocks now. It's not that Norwegian Cruise Lines, NCLH, is it? It's not that Norwegian Cruise Lines is a bad company. They're not. I booked a trip next year on Norwegian. I'm happy about it. I got a great price. What this is telling you, and they beat their estimate. They beat the estimate. What then is this telling you? It's telling you that the economy's in transition, that those who take cruises are affordable for everybody. It's not just for the super elite rich on Wall Street. It's for everybody. What this is telling you is that they're forecasting next year to be a down year for the consumer. That's what that's telling you. This is what I call the anti-wealth effect stock. Anti-wealth effect. When people are rich, what do? They just spend and spend and spend. But when people are getting laid off, displaced by AI, their credit cards are going through a roof, healthcare is going up, their car payments are going up, okay? They're trying to put their kids through college. The financial stress tells you you have to make budget cuts. Where's the first budget cut? Discretionary travel. There it is. Hear me out. If you ever hold through earnings, I'd fire you. You're just fired. I don't even care who you work for, you're fired. You have to hedge this. You have to, even, but it's 22. I don't care if it's $2. You got to hedge it. Okay. You can't hold through earnings ever, long or short of any stock, because you don't know how Wall Street's going to take it, process it, and run with it. All you had to do was buy a straddle or exit the trade. You wouldn't have suffered this. I don't know how low this is going, but what this stock tells me, it's sending a broad message. The market is now officially in the hands of tech. Financials don't even matter, Don. Nothing matters. Nothing. The only sector that's running this market's tech. When tech runs out of gas, the AI story, the correction is going to be enormous. Tech is the only thing running the market because the consumer has now been bumped out. The consumer is on the sidelines. The consumer is not driving the market. That's what this is telling you. Take a look at it. The stocks just don't lie. They tell a story. The last one on this list is called Chop Shop. Chop Shop. Why? Well, as we know, what's another name for SHOP? Shopify. Okay, so what does Shopify even do? Does anybody know what Shopify does? What the hell does Shopify do? Okay, cool name, but what the hell do they do? It's down $3. It was actually down 8 earlier. What does Shopify do? They are engaging in platforms, a commerce technology to start, scale, market, and run a business various sizes across the planet. They have a Shopify platform that allows merchants to manage products and inventory. So they're an inventory management system for merchants and products. The stock has not broken the algo channel. So the stock's still intact. But here's the thing. You have to ask yourself, when does this stock become vulnerable? Now. Why? Because they're an inventory merchant management system. And as consumers pull back on spending and buy only discretionary items, okay, it simply means that as people cut back in spending, it will impact Shopify because Shopify is paid on transactions. They're paid on volume. That's how they're paid. So here, the stock still looks intact. and they reported 20 cents. They missed the estimate. Okay, so they missed by 4 cents. My problem is this. You're buying a stock at 94 times earnings. I'm telling you, one day this stock's going to come out and they're going to report numbers. This is my guess. I'm hypothesizing. And they're going to say, well, it's going to be like one of those like recalibrations like Carvana, where you wake up and the stock's down like 70. It'll be like 50% in a day. People, you can't buy a stock at 94 times earnings unless it's AI. That's the only way you could do this. And this stock ain't AI. This stock's been around a long time. I think this is pretty much the end of the stock's run. They've been running it up on the technology story, but it looks like it's in a topping formation. Were I you, but I'm not, and I owned it, I'd sell the whole thing. Otherwise, if you don't have a trade, this is a great time to consider shorting this stock. It bounced up beautifully, beautifully intraday. Use the intraday bounce to 174 to load the boat short. If ever there's a great short in this market on the tech side, that's the one. That's the one. If I were you, start looking to short Shopify. That's what I'm telling you. Now, I'm going to walk you through something today, and it's a little bit of a task unto itself. And there's no stock. I have a referendum to hate or love, one way or another. But I'm going to bring up HIMS. I have a friend of mine whose wife works for HIMS, and he likes the company. I won't trade it. I don't feel comfortable with it. But I'm just here to make a certain case. I want to kind of make a case going forward, if you don't mind. So today's topical discussion is about a system. It's a trend trading system. If you're a person who loves Corey, you're going to love this. If you like Gianni DePoce, you're going to love this. If you like Blake or even Don, you're going to love this system. The system is unique unto itself because it's a system that integrates both momentum and trend at the same time, which is very rare. Most systems are divided, which means when you go through a list of different indicators, you'll usually have trend, momentum separate. So your eyes have to be averted up and down. Trend is usually inside the price chart. Momentum is usually outside the price chart in a subgraph. The title of this program, and the category is trend. So if you go into my archive, wow, that buy I made is just killing it. What buy is that? I'm not going to tell you. You have to go into the Genesis Cog and become a Genesis Cog member, and then you'll learn. So the idea here is that in my archive, you go to the TheoTrade site, it's in the upper left-hand corner, it says archives. Corey's got one, they've got some legacy, they got Kaufman. Mine's towards the middle of the bottom. It says Jeff Bierman. You click on it, there's 11 categories. This one starts under, you'll fall under trend. So if you ever want to connect the dots here and say, well, I didn't catch the first day, you can always go to the archive day after day after day, and they all build on each other. And here are the different, what I call, bullet points that I kind of like pyramid off or pivot off. And it's a logical sequence the way I follow it. I don't do things helter-skelter. Everything I do is like a blueprint. It follows, it's like a map. You just follow the map, and they connect all the thoughts and all the crux of all the concept, and it brings it all together. So I call this one change of pace. And damn, if there isn't a quote unquote like pun built there, because and the title of it's called the Elder Impulse System Refresher Course. So every 3 years, and this is my 9th year here, every 3 years, I go through and I pull this out of the technical war chest. It's like as a little cute way of describing it. And to me, it's a refresher course that a lot of you need to see. And it's not just for perma bulls or perma bears. It's for both. So for those of you who are like, screw Bierman, he's been wrong every time. I haven't been wrong at all. I'm just not willing to invest or trade a market that's this overbought. But I'm not willing to get short either. So some people sent me emails going, you're such a perma bear. I'm not a perma bear. I'm not a bull either. I'm just an opportunist. I got long positions. I got short positions. I'm just not going to short the S&P because I haven't got the technical signals, and I'm not going to buy it because if it breaks down on a black swan event, I'm going to bankrupt my account. I'm a risk-based manager. So Don't call me like, he's been bearish for 9 months. No, I haven't. I've been bearish for 3 months, and I haven't shorted at all. But I've been trading individual stocks and riding them down. I got an 88% win rate on the short side. So let's push back a little bit on that, people. But I digress. Alexander Elder is one of the 5 greatest market technicians of all time. You're up there with Wells Wilder, Gerald Appel. You're way on up there. You're a Barbara Starr's up there. There's like this Mount Rushmore of these incredible technicians. George Lane, who everything you trade off of was conceived of by these 5 people 50 years ago before your time. Okay? So Elder came up with a system. He calls it the impulse system. You know, impulse, like I have an impulse, right? I don't need to define impulse for you. But the idea here is the key crux concept is momentum changes before trend. If momentum breaks, it doesn't mean the trend's going to break. Today, the momentum's broke, but the trend's still intact, so you can't short it. Stop it. Don't short it. I'm not shorting the S&P. I'm short other things like, what are you short? I'm short a little bit of NiSource, okay? I'm short a little bit, stuff that's just kind of working its way lower a little bit of Bank of Hawaii. I'm not short everything, people, so calm, all right? I'm just telling you that you have to have a change in momentum before a change in trend. Trend doesn't change immediately. When it does, it's usually some like fundamental black swan, unexpected news event, and it just drops out of the sky. That will happen. But absent of exogenous news or a catalyst, it's like Newton's law of physics. An object in motion will tend to stay in motion. It will just keep going in that direction unless there's an opposing force, the inertia law. So the inertia that pushes back means not that the trend is ended. That's not what it says. It says you've run out of momentum. But if you run out of momentum, it doesn't kill the trend. But you have to run out of momentum if you are going to kill the trend in most cases. So if momentum changes direction, it tends to preempt, or what we call, it's a harbinger, it's an omen. It presages a change in trend. So what Elder did was he took 2 famous indicators and he integrated them and combined them together. And then he turned it into a color-coded signal-based system. How friggin' cool is that? You come at me and say, I don't know anything about the stock market. You don't. How about this? Green means buy, red means sell, and blue means don't trade. How hard of a system is that? How much easier would your life be if you didn't sit around there with 100 indicators, listening to all the fundamental garbage and all the agenda from Bloomberg and CNBC pushing their narrative, and just said, hey, all I'm going to do is this. I'm going to sell when it's red, I'm going to buy when it's green, and when it's blue, I'm going to stare at it. How simple is that? That's how simple this is. But there's certain layers of elements that need to go into it. So I'm going to give you a little bit of a historical context to open the discussion here, a little bit of a historical context. So the Elder impulse system, as I mentioned, was designed by Alexander Elder. That's his name. You can look him up, E-L-D-E-R. And it featured a long time ago. He wrote this famous book. It was like the first famous like technical analysis book. It was called Come Into My Trading Room. And people like, what the? That's a lie. People, I'm not smart enough to make up stuff like that. So he wrote this book. And I'll give a little historical context to it, right? Alexander Elder wrote this book, okay? It was called Come Into My Trading Room. I highly advise a lot of you go out on Amazon and buy this book. It is so simplistic and so rudimentary that whether you're 80 years old or 10 years old, you can understand it. Seriously, it's not that complicated. He just walks in and says, okay, he makes it like intelligible for everybody, okay? So according to Elder, this is quote unquote, word for word, when he kind of conceived of the impulse system, he said the system identifies inflection points. Oh man, have I got to bring that out to you. Inflection points. Pay attention to inflection points. Inflection points are everything because inflection points break trends. Inflection points establish trends. That's a fact. And when you break an inflection point to the upside, which is like resistance, your trend continues. When you break an inflection point to the downside, your trend continues to the downside. When you hit an inflection point and you can't break through it and you fail many times where the momentum hits a wall, that's the inflection point that could be triggering you to exit your long position and perhaps get short. It all comes down to these key inflection points in a zigzag format. Brilliant. The system identifies inflection points where a trend speeds up or slows down. That's kind of like elusive to most people. This market has spoiled and destroyed most of you. Most of you have no idea how easy it's been for you. This market's been a one-way Garrett Baldwin liquidity hose tour of walking straight up for 7 months without a downtick. Even today, the dippers are buying. It's been that easy. This market hasn't shown any signs of an inflection point or any signs at all of a change of a slowdown in speed. It's been one steady walk up for a long time. Most markets don't operate like this. They operate where they speed up rapidly, okay, and then they hit a wall, slow down, zig down, and then consolidate. Not this market. There's been no consolidation in 7 months. So taking the S&P is a terrible example, poor example. And most of you are going to get burned because you don't understand what happens when selling accelerates. Because when selling accelerates, okay, and it speeds up, it'll leave you breathless and it'll leave you clueless how to manage your long trade. Most markets work in a zigzag format. You zig up, zag a little bit down, 2 steps up, 1 step back, 2 steps up, 1 step back. That's how most markets operate. They don't have to break trend, but what they have to do is they have to it's like taking your foot off the gas pedal, putting your foot on the gas pedal, and reestablishing some type of speed. That is normal for most markets. But the S&P, the way it's been kind of like the pattern, it's been anything but. So what I'm telling you is, if ever the S&P is going to break, you're going to see it in inflection points. You haven't seen that yet, but you will see it eventually. And the Elder system, the impulse system, is masterful at grabbing, identifying, and colorizing and printing triggers where the inflection points are for entry and exit. That's what it does brilliantly. Something else to throw out. The Elder impulse system is based only on 2 indicators. A 13-day exponential moving average for short term, 13-day. I want to emphasize the word 13-day, not 14. That's Wells Wilder's look back beta testing optimal period. Elder is not. Elder, there are 3 of the technicians are like this. Wells Wilder has his favorite period is 14 look back. Elder's favorite look back period is 13. And Mark Chaikin's is 21. Bollinger's is 20. Every technician, when they go through that system of establishing things front and back, okay, what they simply do is they establish like this one optimal, and it's beta tested where they like this, and they rubber stamp it and put it in all their indicators. Wilder does it too. DMI, it's 14. ADX is 14. RSI is 14. For Elder, it's a 13-period EMA, not an SMA, an EMA, because the exponential moving average carries more weight, 18.18% in the more current periods. It's a skewed moving average of sensitivity. Here's the other part of it. The other part of his system that he combines the two is not just a 13-day exponential moving average, but he uses a MACD histogram. Now, the MACD histogram was conceived of by Gerald Appel. So Gerald Appel's MACD, okay, and the 13-day EMA, which is, nobody gets credit for that. He brings them together, okay? That's the concept. Now, the moving average, what's the point of the moving average? The point of the moving average is to identify trend. What's the point of the MACD histogram? The point of the MACD histogram is to measure momentum. So if you actually took them and put them on individually, exponential moving average, and change this to 13, That would be half of Alexander Elder's impulse indicator. But there's another component to it. The other component is the MACD histogram. Now, I'm not going to sit here and spend an entire week discussing the MACD. You can go into my archive and you can knock yourself out for days on end. I've done at least 20 or 30 MACDs. It's my favorite indicator ever. There's many components to the MACD. There's the MACD signal line. There's the MACD line itself. There's the zero line. There's the MACD histogram. Okay, there's different components of the MACD. This is one component of the MACD that measures momentum but not measures trend. What you realize is when you're above the zero line, the momentum is bullish. When you're below the zero line, the momentum is bearish. It's the easiest thing for any of you to ever understand. Don't think, stop thinking. If it's above the line, momentum. It's not trend is bullish, not trend. Momentum, different things. Momentum is a subset of trend. Trend implies longer term. Momentum implies a fractal or a piece of the puzzle of the longer term momentum. So you could have bearish, bullish momentum, bullish momentum, and still have a long-term uptrend. Did you see that? Momentum is done in pieces, whereas trend is done in chunks. That's the difference. So here he integrates the MACD histogram and the 13-period exponential moving average. You can see that. But this is not how the system looks optically. I just want you to understand what the components are. So as a result of putting the two together, it's like peanut butter and chocolate, putting the two of them together. The impulse system combines trend following and momentum to identify what's called tradable impulses. Tradable impulses. And this unique indicator in combination in color is color coded for price bars for every reference. So it makes it really, really easy to understand. So in summary, okay, if you want to learn more about the Elder impulse system in detail, in full throttle, you need to come into my trading room, buy it, and learn about inflection points. It combines the 13-day EMA, and it also combines, okay, the MACD histogram. Now, let me take a step back for a second. I want to throw down something like just something different. I don't care about Palantir. It's down 14. I don't care. This is not the point. I want you to understand, okay, the impulse color-coded signals. It has color-coded signals is what happens. So this is what you need to know about the color-coded signals, okay? And I'll walk you through each signal. This is just to get your feet wet. So in the Elder impulse system, you have three signals. One of your signals, is green. Green means buy, and that's it. You can only buy. You can buy the dip, okay, or you can buy the rip. But it means buy, go long only. Only. That's it. Never, ever short a green or ever look at a green and leave it what I call, look at it as non-denominational or non-trigger or non-biased. Don't. You can only buy it or long it only. The other part of this is what we call the red price bar. So you're going to see when I present this tomorrow, there's a green price bar or a green price candlestick, because I like the candlesticks best. And then you'll have a red price candlestick. And this one's just as obvious. This one is, okay, sell only or short sell only. You can sell it. If you're long and you get a red, sell it. Get out of it. Short sell only. The last bar, or the last of the candlesticks, is what we call green price candlestick. Blue price candlesticks. And by the way, I need to get rid of that one, pull this back in. The blue price candlestick, okay, is different. And people like, what's a blue price candlestick? It means no trade. No bias, okay? Why? Mixed signals. Mixed signals. That's how the Genesis cog, that's the basis of the Genesis cog. And people like, I don't understand that. Where's he going with this? It's very simple, people. It's very simple. The idea here is that in the Genesis cog system, it's different than this, okay? This is the elder impulse system. In the Genesis cog system, if I get one buy signal, not enough. There's about 5 key indicators. I need validation from 4 of the 5 to take the trade. The elder impulse system is similar. In what sense? It's based upon what's called, okay, logic, or what we call semantic logic. So when you look at all these algorithms programming, they're based upon semantic logic. Yes, no. If the condition is met, it moves to the next question and the next node and the next node. The elder system is telling you that in the green candlesticks, both conditions are met. So if both conditions are met, it's an automatic trigger to buy it. In the elder impulse system, when both conditions of the red price candlestick are met, conditions, semantic logic. It's not one or. It's not, it meets this, but not that. That won't do it. Or it doesn't meet this, but meets that. That's what's called a mixed signal. Mixed signal means that both the conditions are not met. It's not one or the other. It's both. This and that have to be met or there's no trade. That's what the blue candlestick's telling you. That's exactly what it's telling you. So people say, well, then how exactly is the green candlestick or the green price bar? How is that configured? Okay, here is the condition of the green price bar. And I'll call it a bar this time around to save some space. The condition works like this: 13 period EMA. Okay, if it's greater than the previous 13 period EMA, okay, EMA, and here's the other part of it: the MACD histogram is greater than the previous period's MACD histogram. Okay, this is what we call in the business. Okay, I'm going to take off the MACD histogram. Give me some space. I'm going to drag this over so you can see it. The idea here is it's automatically factored into the elder impulse system. Whenever you get a green price bar or a green candlestick, which triggers a buy signal, okay, how does that happen? What is the variable? What is the code that makes this happen? Here's how the code works. If the price moves up and the price moves up above the 13 period EMA and it's greater than the previous 13 period EMA, it triggers a buy signal. But that's not enough. You also have to have the MACD histogram confirm the trend. So the momentum validates the trend. That's how it works. It's brilliant. The MACD histogram has to continually be moving up and be greater than the previous period's MACD histogram reading. So if this goes up and that doesn't, there's no trade. It's what we call a blue candlestick. Get it? That's how it works. If the MACD histogram goes up, but the 13 period EMA doesn't go up, no trade. They invalidate each other. Mixed signals, no trade, no bias. Get your damn hand off that mouse and do not trade that bar. Don't trade the bar. Don't do it. Stare at it and go, that's interesting. Exactly. That's what you're supposed to do. It's interesting. Exactly. Look at it, but don't trade it. All you got to do is follow the rules. Genesis Cog operates the same way. We only do one thing. We follow rules. That's it. Like, when people don't follow rules, people die, son. Remember in Guantanamo Bay with Jack Nicholson from A Few Good Men? People need to follow rules or people die. I feel the same way. When you don't follow the Genesis Cog rules, you are going to lose money. It's a done deal. It's done. If you don't follow the rules here and buy when it's green, you're going to get in trouble. You don't have a system. So this is the green price bar. Now, let me go to the red one. The red one is pretty much almost exactly the same. In the red price bar, okay, the 13 period EMA, ready to get, this is the same thing, right? It's less than the previous 13 period EMA, right? And don't forget the and, because it's semantic logic. And means it has to be this or else. It's not an or. One or the other means it's a buy. It's not or. They both have to be, both conditions must be triggered, or what's called validated, or they also call it confirmed. The other one is that the MACD histogram, it is less than the previous period's MACD histogram. Okay, that condition alone, okay, generates a red signal. So I'll activate it, I'll drag it across, and you can see it. So here is your sell signal. If the 13 period EMA, which means the price action trends lower, and the momentum trends lower, they validate each other. They confirm each other. Take the short sell. So if you're like, I'm short already, then don't short more. Just ride it lower. It doesn't mean you have to trade there. You can, but you don't have to. It just simply means if you're already in a short position, go to the bar and get wasted with Tony Rago. Go have a Mai Tai. Relax. It's going lower. That's what it's telling you. This is a momentum trend-based system. The momentum validates the trend. And when the trend and the momentum aren't validated, you don't have a trade. So it keeps you away from getting burned, is what it does, around what? Inflection points. It picks up on inflection points because what it shows is if you get to a certain, and I'll show it tomorrow. You won't see it today because I'm forcing your hand to come back tomorrow. You're not going to see it today. You're going to look and go, hey, that one's got 4 blue marks. What does 4 blue mean? It's at an inflection point. And what happens when it hits inflection points? One of two things is going to happen. It's going to pivot or rip higher, or it's going to pivot or rip lower. It's fantastic at identifying reversals. Incredible at identifying reversals. I look at it all the time. I have an impulse system up already here. You do? Uh-huh. Look, where's my Bierman impulse? See? See? Uh-huh. It's a color-coded system. If it's green, you can buy it. If not, you can't. You're like, but there's 10 green candles in a row. Then don't sell. I bought it the first green candle. Fantastic. Then don't sell. Let it ride. Let it rip like a Gianni. Let it go. The time you sell is as soon as it turns red, you can sell, or if it turns blue, you might consider selling. The final piece of the puzzle is, okay, the blue candle. People are like, what the hell is the blue candle? The blue candle simply means that neither this has been invalidated, where they don't agree, or they're both opposite. It means the 13 period is going higher, but the MACD histogram is going lower, or the 13 period's going lower and the MACD histogram is going higher. That's what it means. It just means one of the two are not agreeing. So to bring up the blue one is just telling you that, hey, it's that's greater, that's less than, or that's less than and that's greater. So it keeps you from making a mistake. It's called the elder impulse system. And man, it's been around a seriously long time. Now, when you come back tomorrow, what we're simply going to do is we're going to do a deep dive. We're going to go into the color-coded signals and the indicator calculations, and then we're going to add another layer. Alexander Elder said in his book that you can also add a 65 period EMA for a really long term, what they call volatility map, to see how far it might take before an inflection point has reached its maximum level of entropy, which is interesting. So we'll pick this up tomorrow. We'll look at the calculations again. We'll add the 65 EMA, and then we'll start to look at individual stocks And then we're going to eventually, expand this out. We'll look at them on a daily basis, a weekly basis. And for those of you intraday traders, we will look at them on an intraday, cool stuff. We'll look at them on an intraday basis too, which I'm looking, those intraday guys who trade with Tony Rago, it also works on an intraday basis too. Cool stuff. In the meantime, I'm going to turn this over to Brandon Chapman and let him run with it because he's been waiting in the wings. Brandon, this is I think this is a pivotal day in the market. I'm still not seeing traders wanting to step in yet and buy the defensive stocks. They're not doing it yet. Like, for instance, I own Smuckers, SJM. It's going up. I own Bristol Myers. It's going up. I own Ball Corporation. It's going up. Like, I own the stocks that are going up. But Brandon, these defensive stocks are not, like, they're not going vertical. Like, the money managers are going, should I buy these yet? Or should I still continue to buy the dip on Palantir? The market hasn't fully made up its mind that we're going into a correction. Would you agree?
But are the defensive stocks cheap? I mean, you got the news from, for example, I mean, Kraft Heinz. People aren't buying ketchup. I mean, Coke, for example, has negative cash flow. I mean, free cash flow. So again, I mean, that's never happened, right? So the idea is that the reality is, where is there any sort of like safety in the market right now? There's very, very little. Valuations are extreme almost across the board. I mean, we just need to see some sort of corrective move. And we're seeing a little bit that beginning stage of the XLP, right, of consumer staples. But have we hit that point where valuations are really compelling at this point and dividend yields for these stocks are high? I don't know. It's just, we're just, I think, on the cusp of something potentially big, but we don't know.
I think there are certain stocks that are compelling in value.
Sure, there always is. Yeah.
But I don't think, like, for instance, I don't think most stocks, like, I don't see industrials as compelling. I don't see tech as compelling value. I don't see financials as compelling value. Brandon, I'm short the Bank of Hawaii. That's one's getting ripped up today.
Well, we put a bearish trade yesterday on Bank of America.
Did you?
Some flow there. I mean, so yeah, I mean, it's one of those things, like, you got to find ways to try to get bearish at this moment.
Yeah.
We'll talk about our hedge we talked about last week, the triggers from the volatility markets to suggest a 5 to 10% correction off our most recent high. But again, is it too late to hedge? We'll kind of address that question.
My model shows a downward slope on all my indicators. The weekly hasn't broken, which is why I'm still bullish, but the daily's broken. So I'm going to simplify this and let you take this. Brandon, the momentum on the S&P is broken. The momentum's broken, Brandon, but not the trend. Does that make sense? The momentum.
Sure, absolutely. Right. I mean, the momentum broke. We had that large down day a couple of weeks ago, right? I mean, at that day, the momentum stopped, but we formed a new high. So yeah, I mean, the trend's there, but again, this is not your typical bull market. And we'll look at the percentage of the S&P that are above their moving averages for intermediate, long-term, and short-term. And you'll see, okay, what kind of breadth are we seeing in the market right now? The reality is, this is historically bad breadth.
Yeah, it is. I've never seen it worse. I've never seen a market where stocks trading at their lowest valuations in 30 years are just shunned. And everybody's like, it's AI or bust. And that's the sign of a market top, not a bubble, but a market top. And like I said, Brandon, death and taxes were my theme. What do you know about death and taxes, Brandon? They're inevitable.
You can't avoid it.
What's going to happen to this market, Brandon? It's going to correct, because why? All markets correct. It's just inevitable. That's it.
And again, it's not trying to guess the timing of it, right? I saw someone in chat earlier today say, well, it's not going to happen now. Why? Why can't it happen now? There's a lot of factors that could contribute to a major decline right now. Government shutdown and no SNAP benefits, right? We're not paying people's incomes in the federal government. I mean, there are some significant reasons why the liquidity in the system is drying up right now. There's some major reasons why. But again, this isn't about trying to be a prognosticator and say, I know what's going to happen, right? This is about managing risk at a portfolio level.
Exactly. So at this point, like I said, I'm telling people, if I were you, I would start hedging like crazy and upping my ante on short trades, which is what I'm doing, and lowering my exposure to long trades. That's what I'd be doing.
Makes sense.
All right, Brandon, I'll see you.
All right. Have a good one.